That's where his business is, Hainan.
Yeah, that's where he's. That's where,
Hainan is, it's the big island off the southern shore
right.
that they're developing into a tourism, free trade area.
Yeah.
Yeah, that's very interesting to talk about.
All right, let's get him on. Here we go. Hi, David. Welcome. Good to see you again.
Hey, Tom. Hey, John.
It's a pleasure pleasure to see you.
David, thanks very much. What I would normally do, I know we know each other a long time, but I'm going to give the audience a bio. I hope I don't embarrass you too much, and then we'll just we'll fire off on the first question, and we'll start off. So, David Chon, thanks again. You and I know each other for many years. You are currently a professor at an international college in Hainan, by China, living in China, which is amazing. Going back to your history, you started your career in the finance industry after graduating from Columbia University, which I'm also an alumni, by the way, as you know. You worked at the conference board, and shortly after you joined a very special place called Bear Stearns, where as a managing director, chief emerging market strategist, working with people like David Malpass, Jeffrey Dennis, some of the more characters in the emerging space. Then you left in 2000 to go to the buy side. You started your own hedge fund called TriStar Advisors. Then you worked obviously for Discovery Capital in Connecticut, one of the biggest and most well-known emerging market macro hedge funds in the world. Then you started another fund called Atlas Capital Management, and a few years later, 4 or 5 years later, we crossed paths again at Weiss Multi-Strategy Advisors, where I was a PM, and you came in to manage the Asian portfolio. And then you left the United States. You went out to Korea. We can talk a little about your ventures in asset management, both at KDB and Pioneer. And then also at you have an AI development company, which is also very interesting. And now living in China, in Hainan, advisory and in college. So we'll just start off like this. David, you've been all over. You've been on the sell side, the buy side. You've had a lot of experience. But living in China today, tell us a little bit about, let's say, not going into what's happening, but what is the disconnect between, let's say, the international community today thinking about China from the politics or any other standpoint, and what's really happening in China today?
It's a very good question. I think too many people are fixated on what is very well known and obvious about China. So, whenever someone's talking about China, they talk about, growth rate slowing down a little bit, property sector having some issues, um, consumption maybe subdued a little bit. These are all known issues, and I think those three sort of profiles describing China, you could pretty much put that on any other country, and most other countries are experiencing the same thing. So I want to talk about China from a different angle. I want to talk about because I'm on the ground, and one of the things that I've been doing sort of self-research on is to see if China can be a growth engine for the other countries, because we need growth engines around the world. Um, and one of the low-hanging fruits in China that I came across is deregulation. So for businesses, it's easy to set up, but it's a little bit costly to operate businesses in China. And also, if you look at China's overall sort of big international or cross-border regulations, the original script was written so that you prevent people from coming in and you prevent people from leaving. And you prevent money from coming in and prevent money from leaving. So um, modifying the original structure incrementally, it's positive, but at the same time, it's not going to move the big needle. It's not a sort of shock to the system. And late last year in December, where I'm working and living right now, which is Hainan. It's an island province in southern China, and it's not a small island. It's a big island. It's and they fully implemented the free trade port. So going back, if you go back and when we were younger and studying China, we heard about free trade zones in Guangdong and Shenzhen and Shanghai and Beijing, and that the purpose of that was not to sort of shock the entire economy, but have a concentrated impact on certain areas for them to become a benchmark for growth for the rest of China. And by and large, it was very successful. And the success came in because of two factors. One is that they had a sort of a very focused effort to make sure it was successful, but at the same time, the global backwind was in their favor. So the trade and manufacturing actually was on the rise. So that allowed them to sort of gain market share quickly in a increasing pie size. But they are not calling free trade zone; they're calling free trade port in Hainan, and the big positive about the FTP is that the tariff is going to go near zero for most products coming in. So it could become a gateway for products to come into China and to also leave China. So that's one factor, and it could become a huge logistics center for China. Um, so what they're realizing is that they not just making it, but how to distribute and ship efficiently is critical value added, which I think is the right step. And the second sort of big part that people are not really focusing on, but I think it's actually a very big game changer, for, not just for China, but for other emerging markets, is that they want freer movement of money in and out of China, and they want freer movement of people in and out of China. So they want to test this and develop this in Hainan, and if it goes well, then they could roll it out to the rest of China, which is a very prudent way to implement deregulation, in my opinion, because you don't want to sort of create a huge chaos all over China and have it be very sloppy. So they want to do it in a very controlled manner. So my view on China is this: I think the concerns or the risks are well known and well researched. So the demographics, the sort of the property sector going through a little bit of hangover after sort of a very rapid rise. And we've seen this movie before in other Asian countries, and some countries deal with it, and some countries don't deal with it, and then you get like Japan, that's been in a lost decades for since 1990, right? So but I think what China is doing is not just focusing on sort of addressing the current issues. I think they are looking for new ways for the country to grow, and this actually is an important theme for emerging markets in general, also in China as well. But I think one area or one segment of emerging markets where people are not really giving too much attention is in the services sector. I think if you look at the evolution of an economy, just like the U.S. 200 years ago was like 90% agriculture, and then and manufacturing and services was only 10%. Now that 200 years later, that flipped over. Um, uh, but I think if you look at other Asian countries further in their development, the services ratio to the economy is much higher. And so you got Japan coming in around 70%, you got Korea coming in around 60%. Um, And China is coming in around 50%, but at the same time, I think there's a little bit of double counting that's going on. So maybe somewhere around 40% is the right way to think about it. Um, and I think without services kicking in, it's going to be hard for economy that size to just continue to rely on manufacturing, which has been sort of more or less stagnant around the world since year 2000. So, in looking at China, I mean, you can't ignore the obvious topics that many people talk about. But I think there are some low-hanging fruits that's worth monitoring and paying attention. And 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 let's say if I'm a global financial services company, um, you set up shop as a gateway in Hainan, and you get huge tax break, and it's easy to bring your like people in to set up shop, and 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 it could be the headquarters for the China operation. So they're allowing this to take place, and they rolled it out, and it's a big deal. Uh, and I think it's probably not getting enough attention outside. So services and Hainan Free Trade Port, I think these are some of the key things that I think people should be watching in China as an opportunity. But once again, like the risks, it's well known and well documented. There's no value added coming from me. But
David,
I think
this is super interesting. Could you explain sort of is the model then that Hainan would be uh, purely a service economy, not a manufacturing economy? And if you could also explain how is this different from Hong Kong, say, in terms of regulation?
right. So let me deal with the manufacturing segment first. Um, Shenzhen was a manufacturing center, and you know that whole province and that Delta area is hugely populated. So when you manufacture something and when you ship things out, you want the ships to come back not 100% empty. So it made sense for them to manufacture and ship things out. Hainan is not highly populated. It's probably one of the lowest populated provinces in China, and as such, manufacturing is just one way sort of flow. Um, so there's no consumption base in Hainan to absorb sort of the return of importing of goods. Um, so manufacturing is part of, but I think they're focusing on much more value-added manufacturing to be to be located in Hainan. Healthcare, education, tourism. These are all services industries that they're focusing on. They are making a push into developing it as a financial center without a but it's a very at a beginning phase, and I think it's something that I think can develop, and it's one of those situations. Um, they built the framework, and they want people to come in and fill out all the details, and but people are not really sort of aware of what's going on. So perhaps the PR needs to take place and whatnot. But this is all happening like now, like 4 or 5 years ago, they announced it. They've been working on making regulations and system backup, and they went live in December. Uh, so, like in Hainan, if you're a tourist, you could come in visa free for 30 days, which for China, it's making people easier to come in. And as a foreigner, you could go in if you have all the paperwork. You could set up businesses in days, and it's pretty streamlined. So they have a lot of infrastructure in place. They just need people to come in and start painting the picture with their sort of experiences and sort of business objectives. Um, your question regarding Hong Kong, it's a little bit different, I think. I think Hong Kong was one of those places where um, just very low tax rate, strict but very low regulations allowed everybody from around the world to come and establish shop, and it became a sort of a I think it's the people and the caliber of people that actually came to Hong Kong that defined Hong Kong at its peak. Um, and but I think one key difference between Hong Kong and what's going on in Hainan is that Hainan is direct link to the mainland. It's part of China, whereas Hong Kong, you actually have to go through uh, um, customs for to move goods from Hong Kong to 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 the mainland. That's one difference. And I don't think the people are saying that it's going to be next Hong Kong. I don't think that's the sort of the objective. I think what they want is they want a unique area where the deregulations take place, and it can become a blueprint for other parts of China to follow. And moving money in and out of Hainan has become much easier under the Free Trade Port Initiative. And whereas before, um, local financial system was the sort of the rate limiting step in terms of international capital flow in and out. But under the Free Trade Port, it's very well crafted and it works pretty efficiently.
And all transactions are done in RMB in Hainan. While in Hong Kong, you're using the Hong Kong dollar. That's a big difference.
Yes, it's
Yeah.
renminbi transactions on shore.
And if anything you import into Hainan, then you can transit, export, you can move it to the mainland without any regulation or tariff.
I think there are list of items that you can pass through without tariff, but there are list of items that would go through some assessment and adjustment. I think you don't want to bring 100 Rolls Royce into Hainan and let it loose in the mainland. So I think there are some regulations on certain items, but the whole idea is that it wants to be a low tariff gateway in and out of China, which I think is a very novel and novel approach.
Are they going to build casinos there? Is that a business that they're interested in?
Um, I don't think so, because I think if they were going to, they would have mentioned it or done it already.
Okay. And what kind of tourism are they trying to attract? Is it high end international or high end domestic, or what are they looking for?
Right. It's the only tropical place in China, so they're getting the lion's share of Chinese visitors. But it's that tends to be more volume oriented rather than high end oriented. I think there are efforts taking place in Hainan as well as from the government as well as in the private sector to develop a much more niche and um, international, not volume related, but special experience based tourism, which I think um, could be very successful in Hainan. It has a it has a rainforest. It has like Southeast Asian beaches and it has volcanic villages. So and and it takes about 1.5 hours on a bullet train to go from one end to the other. So it's pretty big. And one unique characteristics of Hainan that's different than any other tropical sort of islands is that it has a full circular high-speed rail ring. So you could sort of go around the island using high-speed rail. So the infrastructure is in place. We just need people and money to come in and make it dynamic, I guess.
So, David, if American goes there and they go there visa free, and they spend, let's say, a couple of weeks, can they just travel to the mainland at that point, or they have to go through some
Cannot,
regulation?
cannot. As far as I know, I don't think you can. But I'm not 100% sure. But maybe for you, Tom, they'll make a special exception.
Well, I'm in their system. They know my face. I don't think it's a problem.
No, you're like super big, so they may be intimidated and say you can
Yeah,
go
yeah,
wherever
yeah.
you want.
Tom, don't worry, I'll let you right in. So, Hong Kong is international port center. One of the best ports in the world. Is there a quality port in Hainan? Is it is it does that have the potential like to have this kind of trade like Hong Kong has?
Yeah, they spent last 4 or 5 years ever since the initial sort of announcement, building infrastructure to support it. So they do have uh, new with high capacity port in place, and they also built customs clearing centers that's very high tech and efficient to facilitate large volume of goods coming in and out. So in China, infrastructure related things get done really well. It's the it's and just like in any emerging markets, it's never the hardware. It's always the software, right? So it's the software side where I think where if you are an established foreign businesses and companies, if you have, I'm using software as an experience and know-how. If you have software that you could sort of leverage off of, then this is something that could be very interesting.
Yeah. China is very criticized now around the world for basically only exporting, not importing. It's been very, very determined over the past decade to increase its self-sufficiency, so it doesn't have to depend on anybody for anything. And of course, this is creating a big issue now, particularly in Southeast Asia, where China has become a big competitor for everything. But the way you introduced this initially was that this was a good sign of China opening, of increasing consumer demand. So it sounded as if it was like something that the foreign community would appreciate, because it would be moving in the right direction to instead of just flooding the world of exports, they're actually trying to create local demand and a local economy. It, is that what you think?
So going back to your initial point, which I think is an interesting point about sort of just exporting and not importing, that phenomena was Japan, was Korea, and every other Asian countries. It's a little bit more of a structural issue, in my opinion. And the structural issue is that if you sort of look at global export to GDP ratio, so it's like how much of the world's economy is trade. That number went from like 13% in 1970 all the way to 32, 31% in 2000. So that's a massive jump in like short time. And um, mostly Asian countries grabbed that market share. And as such, their manufacturing was growing much faster than their domestic disposable income and propensity to consume. And so the gap widened, not narrowed over time for some of these countries. So the criticism is there if you just look at the number, but I think that criticism is a function of certain segment of the economy growing much faster than the other segment, which always happens when you have fast growth spurts. And so one data point that I think could be interesting is that as part of the Hainan's free trade port, so the duty-free stores just went, wild in Hainan. So they got duty-free store outlets like all the global big houses, and they're spending. They're you got Chinese consumers walking around with multiple bags, and every holiday they report like, oh, 30% jump in duty-free goods sales, and so they are spending, but at the same time, it's a structural issues that may not get addressed quickly enough. So so the other, if you want to flip the question and talk about here, then why do we not export a lot and just import a lot? It's also a structural issue. It's so you can't so and that sort of touches on one actually very important macro theme for emerging markets in general, in that I think we're sort of as I mentioned before, the export as a growth engine for the world economy has stalled since year 2000, and since year 2000 we use debt as a growth engine, not just in developed countries, but in developing countries. And now, if we have any sort of changes in monetary policy here in the U.S. and or changes in the how the dollar is behaving as an anchor currency, the ripple effect for the world, but it'll be very, very amplified in emerging markets because no emerging market currencies have strengthened relative to the dollar over the last 15 years. And as such, their balance sheet, monetary balance sheet, has increased and kept pace with the U.S. Right? So, and three of us been around emerging markets for a long time, and anytime there's a crisis in emerging markets, it's always balance sheet cycle driven, not income statement driven, and I do think. It's not clear yet how the dollar will behave going forward, but it either weakens here and keep the interest rate low, which may export inflation and other issues, or it may strengthen here and interest rates stay high, which will put pressure on the balance sheets of emerging market countries. And so, emerging markets expand their balance sheets two ways. One is sort of the public sector, which tends to be the case in Latin America, and in the private sector, which tends to be the case in Asia. And but I do think it is prudent for people to start looking at balance sheets analysis in emerging markets to look for risk. So that, I think, is a function of the arrangement that we had. The global order was you manufacture in Asia, sell to the U.S. In return, Asia buys U.S. debt. So that arrangement, if you unravel that, there has to be a ripple effect. You can't unravel that smoothly.
If you look at the past, well, since about you said about 2000, right? You know the period of hyper globalization really comes to an end around maybe with the great financial crisis, right? Since then, trade has, but all the growth in trade really from 2000 on, it's all China. So
Hmm.
it's a period where just China is gaining enormous amounts of market share, right? So it's one thing little countries like Korea growing their trade a lot. When a huge country like China, now the largest economy in the world on a PPP basis, when the largest economy in the world is sort of keeping all the export growth for itself, or now taking share from everybody, that's a
Hmm.
problem, right? And that's a problem now that every policymaker in the world now, that's all they talk about. If you talk to the Europeans or the Americans have just shut off the market, right? No, I mean, the big losers here have been Southeast Asia. You see these economies in Malaysia, Thailand, Philippines, except for Vietnam that's been more successful. But everybody is
Sure.
is suffering deeply from the fact that China is the only one benefiting from export growth. So it's very different. China is so big it it can't act like Taiwan or Korea, right? It's just 10 times the size of those. So the model that you're saying is the model that we've had. Maybe it just can't exist anymore. Maybe it's not viable when the largest economy is the one that's pursuing it, right?
Well, so the way I see it is just to sort of describe the situation. Every country in the world thought the export to GDP ratio for the global economy will go straight line to 50%. So they built capacity accordingly, right? So we're now living in overcapacity of everything. So it's a function of who wants to develop sort of a brand or marketing distribution or logistics network to get your product out to the consumers easily and efficiently. So the one point you raised, which I think is a very important, potentially investing theme for emerging markets, is um, domestic demand in large emerging market countries. So two comes to mind, right? So China and India with a large population. Um, because when the EM specialists are looking at these countries, they're also looking at sort of the global industries, which is somewhat related to trades and tradable goods. Um, but it's not like domestic demand and services industries. But I do think that segment of the economy um, can grow and needs to grow for these countries to sort of maintain certain growth rate going forward. So I do think policymakers will pay attention to sort of before they said let's build factories. And so every country is build factories because that was the game plan and blueprint for all the countries to grow. So for and you can't do this in a small country, but for large countries, I think it's worth monitoring. I think that's going to be important. And and I've been sort of unplugged from Wall Street for a few years, so I'm not really in tune with what's happening in the EM space in particular. But I want to share with you one of the studies that I did maybe about 10 years ago, just looking at EM as an asset class, and just doing a straight comparison to S&P. Risk adjusted, S&P wins, and in terms of sort of asset class performance. So not having EM exposure made you more money if you just had 100% S&P exposure.
Well, 10 years
And you
ago, the
take,
EM valuations were extremely high.
Yeah,
right?
yeah. So, but I looked at it for like maybe 20 year 20-year return. But the and then I looked at what if you went on and off EM exposure, so on and off. That improved the the quality of return significantly. Then I said, what if you go on and off? Then you do long and short. And short is not selling in the stocks. It's selling. It's basically hedging against the local indices and emerging market as an asset class. Then all of a sudden you had far superior sort of return matrix to S&P. So I think EM is when we all started our career, it was right after the Brady bonds were set. That was the sort of first introduction of emerging markets to Wall Street. And when we started our career, it was like discovery. We were discovering new markets and new stocks, and storytelling was sufficient to get people to be interested. Then, like I think '90s, we start doing some serious fundamental work, looking at valuations and growth rates and etc. But the problem is that when the macro winds blow, then the vol that you get from that it's very severe, and so as an asset class, one of the things that I think if you want the asset class to be a sustainable asset class over time, so you figure out how to sort of make the asset class into much more viable long-term asset class. I think on off and some sort of on off plus like a long short it will make the asset class that much more acceptable
Yeah.
with the actual return matrix to
So
sort of
it's fascinating that you're saying that, because that's exactly something that I believed for a long time. A strategy that really, really works well in terms of emerging markets and the U.S. or I mean, if you want to compare both assets, the emerging markets and the S&P, is you buy the asset that's done the best over the past 12 months, and you put all your money in that asset. So if S&P has done the best over the past 12 months, you're all in S&P. If EM has done better, you're all in EM. If you just follow that strategy, so you're once a year, you're basically rebalancing just when that
right.
shifts. Every month you see who's outperforming. That strategy outperforms tremendously. It's exactly what you're saying. It's a momentum strategy. You're only participating, and then you get all the big rallies in emerging markets, and that's all you're doing. You're just catching the big updrifts, and then you're out whenever the market's going down. It works beautifully. And well, hopefully we're now in a so now for the first time in many years, emerging markets is outperforming the S&P 500. So based on that strategy, you'd be completely in emerging markets, and that I think is the correct thing to do, because they do tend to trend for a significant period.
Has the recent China equity performance contributed a lot to EM performance?
No, it's been negative, because you look at the emerging market ex-China outperformed China last year. I mean, outperformed emerging markets, right? So China was a negative performer, and if you look over the past 10 years, it's been a very significant underperformer. So being out of China has only contributed to your emerging market performance very strongly. If you look year over year now, emerging markets is like almost 10% outperforming without China. So if you don't own China, you outperform by 10%.
Okay.
The thing is, the emerging markets ex-China is much more the traditional, very cyclical emerging market asset class, right? When you add China, it becomes a very different asset class.
It is. The rotation of money, like money needs to go get invested somewhere. That phenomena, I think, is also something that you need to sort of closely watch in Asia. So in Asia, um, like property is the number one asset class. So everybody will go into property. So only when that doesn't work anymore, then they scramble. And eventually some of the money will find itself into the equity market. So that's when they get these like local market pops. Uh, and so the in the U.S. we did not have like a property boom like some of these other countries. So all the money went into the financial assets. But it's in emerging markets, the financial assets is like a third class citizen. It's not the primary citizen.
Yeah, if you want to be like in Vietnam, I think you make all your money in real estate, right? That's
Yeah.
because they're in that excellent part of the phase where they're building everything, and like China, that's where you made all your money, but all the big fortunes were made in real estate.
Yeah.
Yeah.
And so it's a tough asset class, but I think it's something that I think if you sort of create a strategy sort of to capture the characteristics of the asset class rather than imposing a strategy on the asset class, I think you'll be much better off. One other theme that I think maybe that I wanted to talk to you guys about is it's both relevant here in the U.S. as well as other parts of the world, is that the erosion of strong middle class, I think, is having some issues or creating some issues in the economy and markets, and it could be much more pronounced in developing countries than developed markets where the institutions are stronger and etc. So it's something that it's not clear to me how to sort of analyze that and play that from an investment angle, but just as a sort of a sort of on-off risk factor it'll be worth monitoring and sort of measuring. The middle class erosion in some markets, I think, are it's pretty substantial, and the only
I think that
reason, yeah,
I think that's linked to the deindustrialization you've seen in so many
right,
markets,
right, right,
because manufacturing was something that created a middle class, and once you turn to low value added service economies, then you don't have a middle class anymore. You just have a bunch of very low paying jobs. So you've
right.
seen this dramatically in countries like Brazil, where the middle class has been very eroded. And it's probably happening in Southeast Asia, where manufacturing is losing its ability to compete.
Yeah, so the stagnancy of the middle class, I think, is much more appropriate description. So, the after feeling the vibrant sort of dynamic economy, then all of a sudden, as a middle class, you stall and you see like cost of everything that you consume go up, and so the squeezing of the middle class, I think, is happening, and it's not clear when or how it'll sort of become a risk factor, but it's something if it happens, it could be very powerful situation. So it's worth monitoring. So I wanna throw it out there for you guys to do homework. We used to follow price of haircut in Brazil, in Sao Paulo, to measure the service industry and purchasing power has anybody gotten a haircut in Brazil recently where you could give us some sense as to
No,
I have
no?
this. I will say this, that I talk to a lot of younger people, like about people call me about jobs, whatever. And a lot of the younger people, I don't know this, are saying that they're getting offered jobs, but at the wages, I mean, it's like in dollar terms, it's just like it's really low. like
Really?
less than $1,000 a month. Like, okay, you can come work for me. I mean, so a lot of the younger people coming out of schools, there's not a lot, so they're taking internships and beginning jobs, and they're getting paid extremely low wages. Like, I was shocked how low some of the, and so the price of a haircut has to be. Everyone tells you that Brazil's very cheap. Like, I had one of my
Right.
partners went to Brazil. He's from Brazil. He just said things were just so cheap down there. So I don't know what the price of a haircut is, and do I need one? Uh, it's probably pretty low given the wages they're paying for, let's say, entry level workers are very
Right.
low right now.
Right.
How,
So
how
this is
different is that from the Big Mac index? It's probably pretty similar, no?
it's so Big Mac is sort of material cost making the price of Big Mac. Haircut is 100% services, right? So it's you paying for someone's skill. So it's a different way of measuring sort of purchasing power. But we used to do weird things. We used to measure pork prices in China on a weekly basis, and it just this is when with Bloomberg didn't have all the information on their system. But now it's easier, I guess.
It's actually, when you look at the Big Mac index, the cost of the materials, the beef, the tomatoes, is actually pretty irrelevant. You see countries
Oh,
like Brazil at times having, Brazil has very cheap beef, very cheap tomatoes, but sometimes can have an extremely expensive Big Mac compared to Asian countries, that have to import all their beef. It's really, so I think it may be more like a service thing. It's the running a
yeah,
business. It's all the cost of running a retail business, and that impacts, at least in a place like Brazil, it impacts it a lot.
right, right. Yeah, interesting. I haven't looked at Big Mac index in like a long time. Uh,
I do look at it. It's interesting. I
Dave,
was
so
wondering,
yeah.
would you, I wanted your opinion on, do you think India is a new paradigm? So, what's worked in recent years has been the mercantilistic paradigm, the export your way to prosperity. And India is completely different, right? India is not going to export its way to prosperity. So maybe it's something more like Brazil in the 60s or something,
Hmm.
or maybe something completely different. What do you think of the Indian model? And do you think it's the big hope for emerging markets to have something that's more sustainable, so something that's more long-term profitable growth?
Um, I've been a India bull, or I was an India bull in early 2000 when I went to meet all the companies there. Um, because in the 90s, all these companies built capacity thinking India is going to become the next superpower, and it did not materialize. So they were all sitting on excess capacity with declining inflation. So I thought the demand will pick up, and they didn't have to sort of pay for invest in additional capacity. Um, Subsequent to that, I think India has evolved somewhat. It's not just pure manufacturing, but um, it has other industries that may not be sort of well represented in other emerging markets. Um, India is a complex story from a sort of a political point of view because we see it as one country, but it's actually a collection of many different states with very strong identity. So to do anything at the national level, it takes tremendous amount of effort, and usually don't do it proactively until things break down, then they will move. So the if there's one country where infrastructure investment would just unlock huge potential, it's India. But because of the state's involvement in granting land and etc., it always run into problems. But I think India, I highlighted India earlier along with China as being a big domestic demand market. And the problem with India always has been the macro. So like you have, the setup around the world is that the monetary policy for emerging market is dictated by Federal Reserve, and yet they have sort of open and free fiscal policy, right? So whenever the problem or gap emerges between that versus this, then you have problem. And India had repeated cycle of this problem with inflation. So the stabilization of inflation is actually creating sort of sufficient critical mass of population with enough disposable income to sort of show domestic demand, and I do think it should be noted because it's a such large market, and I do think, and maybe I'm wishing, I think India and China doing well will lift all boats in emerging markets because, like you were saying, if a small country and small market does well, it's not going to move the dial. So you need big markets and big economy to do well. So stability of macro, I think, is a very important sort of condition for India to sort of start consuming and forming a viable consumption base. And I think that's now in place. And so, um, unlike other countries, India has a big software industry, which I think it's not classified as manufacturing; it's classified as services, and so, and it also has pretty decent pharmaceutical. So, there are elements in the Indian market where I do think you could sort of play the pure domestic demand. So I think India is worth monitoring. I don't think there was an old saying in India that um, no one will win any election if onion prices are going up. So that's how they're sensitive to like sort of inflation. But on the other side, if the onion prices are low and stable, then everybody's happy, and they figured out how to control that, and as a result, you're seeing much less volatility in the political scene in India as well. So it's a little more stability, so that the swings in the political spectrum and the players are not really sort of doing a yo-yo effect on the policies. So India is worth watching and monitoring, in my opinion.
Yeah, one of the big differences between China and India is in India, the private sector drives the economy, and the sort of the titans, these usually powerful families, are not really restrained by the government. They're in many ways they're promoted by the government, at least under the current administration. That's very different from China, right, where the state sort of runs everything, and where the party doesn't like private companies becoming too powerful, right? And so you have the
Well,
case in China where the one of the reasons the stock market doesn't do that well is because companies aren't that profitable. Right? There's a well in India they are very profitable. They're growing and they're not threatened by the government.
yeah. So when I started as a analyst at Bear Stearns, we were looking at that's the onset of the transformation in China. And at that time, 95% of the economy was state owned, and 5% was private. Um, And what I thought was a very interesting and viable strategy was they did not want to shrink the size of that 95%. They just want to make that 5% grow at a just crazy rate. So over time, that becomes the majority. And then in 20 years, they flipped that around. But the the legacy and social structure of the state-owned sort of economy is still there. Yeah. But having said that, I do think there are private sector companies that are doing well and becoming big. And I think so. I think that's a good sign, and you get into this symbiotic relationship where private sector companies doing well, creates job, helps the economy. It's all good. So, China is evolving that way. India is sort of these mega companies with the government relationship is a little bit of black box for me. It's and then it's not black box for the information, but it's black box. You can't model that thing. Yeah, it's a sort of so it's a little bit of sort of unknown. But even with that, I think it's worth the risk. Which emerging market country is free of risk? So that's when you run an emerging market portfolio, especially if you run a global emerging markets hedge fund, I don't think I got one decent night's sleep in New York like in 10 years. There's always something blowing up. But the but it's an asset class that I think where if the developed countries are saying, okay, so we're gonna go plateau here, I think it gives an opportunity for some of the emerging market countries with the right framework to use this environment to rise. But having said that, these types of transitions that we're sort of talking about or potentially entering was never smooth in global financial markets. So that's something, you know, where's volatility now, right?
David,
Do you have an opinion on the decline of the United States? The
I was just going to ask that.
the how far down are we on the road to hell?
So
And is this positive? I mean, this driving the dollar down. It's driving gold up. Maybe it's good for emerging markets.
yeah, so I try to have a personal rule: don't talk about politics and don't talk about religion. Um, so let me sort of come up with so this podcast could go into EM unhinged very quickly if uh, but the let's look at the dollar first. I think um, the physical benefit of owning dollars and owning gold and producing gold, I think it's small. I think the big impact is um, if every monetary policy is tied to the U.S. and the dollar, and if dollar weakens, what do? Right? So if you're a EM country, you either let your currency strengthen against the dollar or you print more. You create more liquidity. And you create more liquidity when the velocity of money has gone to zero everywhere in the world. So what does that do? Well, it maybe push the asset prices, whether it's physical assets or financial assets. Uh, but that creates, so I always try to look at things from sort of is the situation getting into more of an equilibrium or moving away from equilibrium? And in my opinion, that's moving away from an equilibrium. So um, uh, so the dollar weakness and rising gold, I think, is it's actually not a good sign for emerging markets. And coming out on the other side, it may be, but while the transition is taking place, every country has to retool its monetary policy, or keep it and suffer the consequences. It's a and then you don't have to look far to get what kind of economic impact that could have. Just look at Japan over the last 30, 40 years. It's a it's so so you know that's going on in the U.S. So the view on the U.S. why is it messing around with the dollar and the sort of the global order as we know it? Um, I don't know what the motivation is, um, but I think if you think you could have this and this too, but two may be related. Maybe you could have just one. So, you know, when will the sort of U.S. debt become inferior in instrument or riskier instrument because of the currency movement? Um, then we have to sort of adjust to that. Maybe higher bond yield here in the U.S. For period of time, or less debt spending. Either way, it's restrictive. It's not good for the U.S. So I think that part of the program has not really kicked in yet, but that's worth monitoring. How the other countries are. The holders of the U.S. debt, what are they doing on the back of the weak dollar? So that's and U.S. U.S. debt is held by a lot of the countries that we're talking about during the podcast. So we'll see what happens. Um, View from the outside. So every time I come back to New York, it feels like the U.S. CPI is not going up, but the CPI in New York is going up really high. Like we order you know pie. We ordered a pie, pizza, like $60 pizza. It's crazy. And I'm going, oh, it better be good. But actually, it was good. But at the same time, the joking aside, um, inflation is higher in the U.S. than what the numbers are saying. That's for sure. And that's causing erosion of purchasing power in the middle class. That's for sure. And we've seen in other countries when middle class gets marginalized, how the political spectrum goes from extreme left to extreme right. Brazil is a classic example. Uh, and so until things break down, there's no means to address it, because when you look at cause and effect, and when you look at source of the problem, um, you have 4 or 5 years to fix. So what do? You don't do surgery. You put Band-Aid on it, and then you give aspirin, and then will the problem go away? No, it just you don't feel it for a few months or a few years, but the problems are there. So I think uh, the view of the U.S. from outside. Um, I have some American friends out in Asia. When they ask them, "Where are you from?" and they say, "Oh, I'm a Canadian." Joke, joking. But it's it's a little bit surreal on how fast things are sort of changing, and the more surprising is how the sort of the changes are sort of sticking. and it's not sort of. So it's a little bit strange. But I mean, you guys are sort of living here, but I'm an American living halfway around the world, and looking at what's going on. Sometimes I just have to shake my head. But
It feels like Trump's
it's
been he's been here for 10 years, but he's only been here for 1 year. We haven't had it 3 years.
David, when you look at sitting in your seat in China, and you're paying attention to everything, and what do you think the party is thinking about to either to reinvigorate or to replace the engine of growth, which was real estate? Because it's dead. It's been dead for a long time, and it doesn't look like anything they do is going to revive it. So what is going to be the replacement? And so if we're going to really see China growth pick up, where's it going to come from?
Yeah, so I think just like the sort of the maturing of Asian economy, once you finish that 10% per annum growth rate, you ain't going back to 10% per annum because the base is too big, right? So then the question is, what is the right growth rate? But more importantly, and you're alluding to this, what is the right quality of growth? Because you could make growth a number, but it's the quality that will impact the overall economic sentiment as well as sustainability. Um, so I don't think they're looking to get back to 10%, but I think they're focusing on high tech area for future growth. So um, as far as R&D at the country level into high tech, it's pretty substantial and increasing, and they're focusing. Um, and also, their sort of initiative in Hainan, which says, okay, what other types of growth that we can make? So deregulation as well as bringing in more more global services industry development. So those are the three areas that could supplement uh, the sort of the slowdown in the manufacturing sector. One of the um, if you go into one of these like big sort of manufacturing sort of online apps and look for just for fun, you should just go in and say fork and spoon manufacturers, right? Then you get 10 per page, and you get like 20 pages. And if you add up all their monthly capacity, it's like, like you can make spoon and fork for every people on this planet every 6 months, right? Uh, so we know that, okay, that's too much, and some of that has to disappear. So when you look at aggregate economy or GDP, you're measuring what is disappearing. It's a net concept. So what is disappearing and what is creating? So the creating has to sort of come up fast enough to balance. So think about like U.S. without services industry. So if we only depended on manufacturing, it'll be pretty bad here, right? So, is it coming up fast? Is it being supported from policy point of view to sort of allow that segment of the economy to grow fast? I think that's the sort of the right way to think about how to make more quality growth coming out of China.
But you guys, you must know Michael Pettis, former Bear Stearns. You must have worked with him at Bear Stearns. He has a very sort of a different view on China. He thinks that the debt is really growing at way too quickly, and that's because growth is very unproductive. Do you have any thoughts on that?
Okay, that description fits 99% of all the countries in the world today. So why is it only a problem in China, right? So Japan's
Yeah.
public sector debt to GDP right now is at 400% or approaching 400%.
Mm.
So if inflation goes up by 2% and if the JGB's
Yeah.
yield goes up to 2%, their annual federal budget is 15% of GDP. Out of that, they have to spend 8
Yeah.
percentage points on interest. So numbers don't add up everywhere, right? So I think I didn't really work with Michael, but I know of him. He worked in the fixed income department and worked in the equity
Right.
side. But we did overlap, and I know of his views, and he's a very famous person in
Yeah.
China.
So your point is a good point that this is a problem that a lot of countries have. Now, there's some don't have it, like Mexico has very low levels of debt, India relatively low, Turkey exceptionally low. So maybe that's a good investment strategy for emerging markets. Invest in those countries with these low debt levels.
Maybe these countries learn from their past sins. So not to lever up, but so analyzing balance sheet as a source of binary risk, I think is an important. It's probably a lost art. No one really analyzes balance sheets anymore.
No.
But I think we're coming to an end of one cycle, and I think whenever there's a turn in a cycle, then you get these surprise events, and I do think with strong conviction that it's the balance sheet, not the income statement.
David, thank you. This has been amazing. Safe travels back.
EM unhinged. Thanks for having me, guys. It's been fun.
Yeah, it's been.